Good morning, everybody. This is the live market open for Friday. Good Friday. Thank God it's Friday, February 12th. I'm Yohay Elam, Forex Crunch and Market Movers podcast, doing the show as usual for FX Street. Good to see you all in the room. Today, as usual, we're going to talk about recent developments in markets. Yes, more negativity, but perhaps we're getting close to the end, or at least some kind of relief. Various charts and levels the next 24 hours, and of course, your questions. Actually, I already see here one question. Oh, just a comment from Sinatra. Good morning. German GDP slightly disappointing, down from 1.7 to 1.3, 2.3 consensus. Yeah, expect Europe bound to follow, which means the growth rates are decreasing and heading for negative territory. Yeah, actually, quarter over quarter was okay. We'll talk about that immediately. Okay, quarter over quarter, German GDP was 0.3 as expected. Year over year was slightly disappointing. Okay, but let's talk about things that had bigger impact on markets. Yesterday, we had an ongoing crash during the show also of dollar yen. In general, a surge of the Japanese yen across the board, safe haven flows. At some point yesterday, we had this spike. Was this an intervention by the Bank of Japan? Looks very much so. Okay, so let's begin with dollar yen. This is the hourly chart. Perhaps if we go to the 15-minute, just to emphasize this spike right here, it was around noon GMT. Quite a big leap from around 111.40 to almost 113.20. Something like nearly 200 pips instantly. Then we had it fall back to range. Okay, this seemed like an intervention by the Bank of Japan to weaken the Japanese yen. Okay, perhaps also the Swiss intervened. They do it all the time, but this seemed like a move. The response to questions about this was no comment. Okay, adds to the mystery. In addition, we had talk during the Asian session, during the Japanese morning, that the Japanese government is meeting with officials in the Bank of Japan. They're considering talking about an emergency meeting by the Bank of Japan to address what's going on in markets, a sense of urgency, all these kind of high alert comments. Good morning, everybody. Okay, so the currency war, as I see it, is escalating to a new level of war. It's not only just setting negative rates, printing money, and things like that. It's also intervening directly in markets. Now, the Swiss are doing it for a long time. The Japanese have done it quite a few times. Usually, these things fail. In order to have a successful intervention, you need to intervene in the right time. Intervening in the right time is not trying to catch a falling knife in this case of dollar yen, but actually trying to, once things have settled down, then to go with the flow. Once dollar yen is stabilized, perhaps then to push it even higher. Okay, not to fight the trend. Well, the same goes for traders. The same goes for central banks. Anyway, we're in a new and exciting phase in these currency wars. What I think we should do is take account of this and perhaps not trade currencies that are vulnerable to interventions like the yen. Perhaps there might be more excitement. Perhaps you can say, okay, we trust the Bank of Japan to successfully intervene, and then we can ride dollar yen higher. But many interventions in the past, including from Japan, of course, have failed or a partial success, or perhaps, if you want to take another look at this, they provide an opportunity to short. Let's go back to the chart. If you were watching the charts yesterday, so you had perhaps the chance to see, okay, here's the spike, here's the Bank of Japan, let's fade them, and then you had a slide back down. Okay. In addition, in general, we have a negative market mood. Okay. Headlines, maybe you've seen them. The global markets are in a bear market. Okay, that means 20% off the peak or off the all-time highs, depending on the definition. But anyway, what matters for us is that the headlines remain negative about stocks. Okay. Another reason is, of course, ongoing worries about German banks, particularly Deutsche Bank, exposed to commodities to commodity bonds of companies in the commodity sector. Okay, more rumors, but the Bundesbank had to deny these rumors. That means when you deny something, well, I think when British politicians said don't believe anything until it's being denied. So I don't know what's going on, but just be aware that there are problems in German and Italian banks. Yellen gave her second part of the testimony. First of all, she repeated what she said yesterday, the day before on Wednesday, about balanced statement. But then when she was asked, it was a long session of questions and answers. Basically, the headlines that came out were it's not our fault. Okay, the fall in stock markets is not because of the Fed rate hike. There is some truth to that. There are also other problems. Of course, she blamed China, even though China should not take all the blame, especially this week as Chinese markets are closed. It's the new year. They're getting ready to come back. There are a few releases on the weekend as well. But of course, it's also the fall in oil prices, which hurts American companies. It's German banks hurting the global sentiment. I mean, it's quite a mix, but it's sort of easy to pinpoint the rate hike of 25 basis points of the Fed and everything that's gone wrong in stock markets. Okay, so stock markets fell not over 1% in the S&P yesterday, but in the Nikkei tonight, after just a one-day bank holiday in Japan, they fell nearly 5%. Okay, so that added in sentiment. However, this morning, situation already looks better with some kind of rebound. That's why I began the show by saying that maybe we're going to see some kind of correction. Okay, and this means a lot for the euro and the yen, the safe havens, that maybe they will correct. Now, another thing, of course, oil prices reached another low of Brent crude fell under 30, and WTI reached 26, digging the bottom of the barrel. Yet again, we had headlines about OPEC talking about doing something, but I don't see anything serious over there. I also had a tentative agreement or tentative declaration about a ceasefire in Syria. Unfortunately, I'm a bit pessimistic that this will last, but anyway, less tension also in the Middle East makes oil prices a bit lower. Anyway, let's European stock markets are not doing as bad, and this means that we have some relief for markets in general, and specifically dollar yen is now a bit going up. Perhaps we have another intervention, but this also could be an improvement of the mood, less risk off, more risk on. Okay. Anyway, we can talk about levels here, but things are a bit wild, especially with the suspected intervention yesterday. I would say that 111 seems to be some kind of bottom. Resistance, I see it at 114.25 because the pair stopped there. Perhaps before that, we have resistance right here at 113. We can ignore that spike yesterday. Anyway, dollar yen remains extremely volatile. Already this morning, we have a range of 140 pips. Okay. When we talk about safe haven, we should talk about euro dollar as well. Euro dollar is falling this morning. Okay, yesterday we had it reach the levels of 113.75. Curiously, 113.75 was a line back in 2003. Okay. A bit. I know it's in the distant past, and perhaps you want to ignore that, but support here in 2003. But I would still say it's of importance because it also worked as as some kind of support and resistance in the previous months. Let me find that. Well, right here, it worked as resistance, so I would say it's some kind of resistance at the moment. Currently, we have retreated from that line. Better mood in markets, better European opening. Remember, it's all about the moods these days more than about actual data. Okay, so support, I would say, 112.50 is the new line I put here, 113.75, and further resistance 114.60 and support 110.70. Okay, I see here a question. I expect a relief on DAX up to 9,000, 9,300. Yeah. So we could see it fall back to 112.15, or, well, we'll see. Anyway, I don't think this positive mood will last too long. I think it's a correction within the doom and gloom, okay? But we'll see. Let's look at oil prices. I mentioned it so many times. So yesterday we had this big fall. This is the hourly chart. We had it fall to around 26.03, I think was the bottom. We went up once again above 27, currently holding on above 27. Currently, it's not really correlated, the better mood in euro and dollar, and it's not reflected in the recent hours in oil, but in general, oil is off the lows, about $1 off the lows, and the dollar at these low levels is quite a lot, okay, in terms of percentages, okay? So I think we still have some kind of a better mood in markets this morning. I think it's a correction. Okay, let's talk about other currency pairs. Pound dollar, better mood, rising also just a bit. 143.65 I think proves itself as significant support. Resistance far above 146.50. We're currently stuck in this range. Okay, dollar CAD. The Canadian dollar, as I mentioned a few times, has shown a bit more resilience to oil prices. So yesterday we had an attack on 140 with the fall of oil prices, but we didn't break it. Now we're back down to 139.20. Better mood means a bit stronger Canadian dollar, but oil prices way, so it's more or less balanced this morning. Support 137.87, resistance 140. Okay. Aussie dollar. Overnight we had Glenn Stevens, the governor of the RBA, release a statement. He was more or less balanced. He said that the fall in commodity prices goes hand in hand with the fall of the Australian dollar. Currently, we're in the same old range. 71.40 is resistance. 70 remains support. Okay, see here another comment. I started to write a little morning analysis for a friend who has his money in the DAX, knowing nothing about it. I agree with you that we will see only short relief in stocks and crude. Okay, thanks. Kiwi, well within the range. Yesterday it had another spike above 67, or else we should adjust this line or add another line right here at 67.40. It's shaping up as another line of resistance. Anyway, support is at 65.80. This line still works quite well as support. Okay, dollar Swiss in low ground under 98. Found support at 96.40. Some kind of resistance. Maybe here at 90. Well, this already is an old line. So 98.20 is some kind of resistance. Anyway, prone to intervention. Look at this move here on Euro Swiss yesterday. Okay, this also smells like an intervention. It came about the beginning of the move higher began before the Japanese move, but then accelerated when the Japanese authorities seem to have intervened. Anyway, we have a spike higher here above 110, holding above 110 at the moment. Smells like the S&B is intervening. Also, currency to stay away from. Euro pound, we had a rise above 77.40, which worked very nicely as a separator of ranges. So far, the break is holding. The next line, 78.70. It was a temporary spike that I think we can fade. Anyway, the range 77.40 to 78.70, quite a nice range. If we have a deterioration in the mood, we could see the pair move higher. The euro is a safe haven. The pound is a risk currency. Euro yen. This might also frustrate the Bank of Japan because we're back to even lower ground. Okay. We had euro yen trading in this range, 127, 129. Spike higher because of the move, the negative rate set by the Bank of Japan, and a gradual deterioration to the downside. The yen is a safe haven than the euro. This explains the strength. Yesterday we talked quite a lot about pound yen. It remains very exciting. Found support here at 160.24. Now even I would say, let's make it round. Let's make it 160, and bounced back all the way to nearly 163.80, which was previous support. Currently battling 163. Lots of sharp movements here. Currently, we're seeing an improvement because of the correction. So, well, not such a big move in comparison to what we've seen in previous days from pound yen, but certainly a very nice move to the upside from the lows. Okay, so here we are. Let's take another look at euro dollar, and then continues falling. Better mood in markets, not related to German GDP. As I see it, German GDP came out at 0.3 quarter over quarter as expected. Slightly disappointing year over year at 2.1. Okay, we have some figures from Spain now. Not as important as inflation figures from Spain as expected, year over year fall of 0.4. It's the final figure, if I'm not mistaken. So anyway, we'll see fresh figures for February regarding inflation, and then we can talk about how this will impact the ECB. Month over month, a big fall of 2.5% in prices here in Spain. These are that's the European standard. On the national figures, it's also more of the same. Just after the show at 9 GMT, 10 European time, Central European time, we have expected GDP from Italy, the third largest economy, and now the focus of problems in banks. Okay, so we are seeing, we're expecting a rise in year-over-year growth in Italy from 0.8 to 1.2. On the quarterly basis, we expect 0.3, like Germany, and a bit higher than we've seen from Italy last month. Okay, last quarter. Okay, these are figures for Q4. What we have later on is, of course, wait, something is missing here. Yeah, a small country called the United States of America. Okay, so before we reach America, we have at we also have the all European figures. Okay, GDP. German, French, Spanish, and Italian data is out, but this doesn't mean we could not have surprises. Expectations are for a small fall from 1.6 year over year to 1.5, and quarter over quarter. Yeah, no change. Okay. Anyway, the big releases from today come from the United States because GDP in Europe is mostly out. Okay, so we have at 1:30 GMT retail sales. These are figures for January, the first month of 2016. Let's see how things go. On the headline, we're expecting expectations are very low, a rise of 0.1% month over month. Remember, these are seasonally adjusted figures. So if there's less Christmas shopping, if there is less shopping after Christmas, it will not be reflected here. What matters is the seasonally adjusted, what people usually buy in January. Okay, that's the headline figure. The control group is perhaps even more important because it excludes volatile items. After a very disappointing fall of 0.3 in December, we expect a rise of 0.3 in January. And another core figure is excluding auto sales. It's expected to be flat after a drop of 0.1. Okay, we also have import-export prices. This is a bit second tier. And then the more important event comes at 3 GMT. We have the preliminary consumer sentiment for February. Okay, this is sort of fresh data. Let's see if the mood in markets also reach consumers, if they're also feeling the doom and gloom. On the other hand, the falling oil prices leaves more money in their pockets. A small rise from 92 to 93 is expected. So we have a focus on the consumer. In the United States, we have, let's see if I didn't miss any other event. We have first of all, retail sales for January. For import prices, well, they're expected to be terrible. And US consumer sentiment at 3, which is for February. So big focus on the consumption. A lot of the US economy is consumption. Also at 3 GMT, we have Bill Dudley, number 3 at the Fed, the president of the New York Fed, speaking. Let's see if he continues the line of Yellen, more or less balanced, watching and waiting, data dependent, talking about financial conditions that might slow rate hikes and things like that, but also saying that the rate hike was fully justified. Or if he talks about negative rates, something that Yellen just mentioned as an answer to a question, okay? In early September, Dudley did give us the hint that the Fed will not hike in September because of the turmoil in markets. So, and he's sort of a center dove and number 3 at the Fed, a permanent voter on the FOMC, so his words do matter. Okay, any questions? Meanwhile, I'll show you implied probabilities for a rate hike in the United States. This is the chance, according to bond markets, for a rate hike in February 2017. Yes, 1 year forward. Basically, no cut is expected, but also no hike at all. Okay, almost 95% against a rate hike in 1 year. If we're talking about March, it's no chance. April, almost no chance. June, July. Well, basically, bond markets, bonds are rallying. That means bond yields are falling. So we have a negative situation in the bond market. I mean, reflecting a bad situation about the economy. Okay, any questions? Let's talk about other stuff as well. Meanwhile, euro dollar is falling. We'll do as usual on Friday a preview for next week's events. That will happen after the wrap up. But we still have time for questions and perhaps for other charts. Okay. I mentioned many times the political situation here in Spain. Well, it's more of the same. It's stuck. There's pressure from Brussels to get something done. Another thing that happened in markets is that the IMF re-elected Christine Lagarde for a second term. She had no challenge from nobody. Regarding Greece, it remains in the back burner. There's still no full agreement, still no discussion about the debt. Anyway, I think this situation in Greece remains terrible, and that without any kind of debt relief, the current agreement is doomed to fail. Okay. Any questions? Oh, something I forgot to mention. Yesterday we had jobless claims, the weekly release from the United States. It came out for change better than expected at 269,000. It's a fall from previous levels, which were above 280. Some analysts, I think especially Goldman Sachs, look at the jobless claims around the second week of February, the time of the NFP survey, and this gives them a hint about the non-farm payrolls, okay? So if we had now in the second week of February a better than expected release in jobless claims, that implies that we'll have a good jobs report in March, okay? That's only one of so many indicators, and as we know, non-farm payrolls is a lot of a guessing game. Anyway, just a small anecdote about what's going on. Where do these US jobs come from? Well, we've seen in, I think, the retail sector enjoyed some job gains in the last report. Of course, the mining sector is losing jobs because of oil. Another question here. Will China come back angry or happy next week? That's a good question. I think many expect China to act. Many blame China. It's not only China. Remember, other parts of the world are not growing. Very fun to blame China. Janet Yellen talked about the devaluation of the Chinese yuan. This sounds totally political because there's been a devaluation of 2-3% a maximum, and the Chinese authorities are trying to stabilize the yuan to mitigate financial shocks. There's so many other problems in the world. You can't only blame China for not growing as fast as they grew. What we could have from China, of course, they don't want a situation where the slowdown is too much, and when people don't have employment. If people don't have employment, they get angry with the authoritarian regime. Okay, maybe there are worse regimes in the world, but China is not exactly a free country. So perhaps they will do more in stimulus. Now, China does have many tools to act in terms of stimulus. They already did a lot after the financial crisis, but perhaps they did too much in infrastructure and investment. They want more consumption. Maybe they can do something like, central bank in China, the People's Bank of China, PBOC, has actually a positive interest rate of around 4%. You can always cut that. They can cut the reserve ratio requirements from banks, and they can eventually do some QE. Okay, seems a bit far out for a country that's growing, but you never know. Okay, it seems that wrote an article about that in Forex French that central banks, that markets are beginning to lose the faith in central banks. Okay, they're beginning to. What Draghi did in December was not enough, even though he cut the interest rate and pledged more QE. Longer QE. The Federal Reserve did a very well-planned rate hike. It seemed to pass on very nicely, but eventually it began backfiring. Now, the Fed is also blamed for that. Okay, so and when Janet Yellen tried to soothe markets, it certainly didn't help. Okay, and of course the Bank of Japan, when dollar yen reached 116, the BOJ began talking, lifting dollar yen very well, then set negative rates, a big historic move. Dollar yen went all the way up to 120, 150, and then it began falling and it began deteriorating. And I think markets smelled the lack of competence of the Bank of Japan, and dollar yen sold off even further. Okay, and also these interventions seem limited. So maybe the central bank in China, the People's Bank of China, can do the work for the other central banks. Who knows? So maybe they'll come back with lots of energy, maybe not angry, maybe not happy. Okay, see here another question. What is this awesome media play too often about the China blame game? This is it. Yeah, talked about that. Would have bought that if that gotten my eyes opened by you and Dale. Yeah, of course, the world depended on China too for further growth, but it cannot last forever. Thanks for the comments. Dale has his show later on, the great live analysis room. Okay, let's get back, show you some charts. Still a fall in euro dollar. Okay, any more questions? As I said, we'll do the wrap up relatively early and then a preview for next week's events, which of course features the return of China. The year of the monkey has begun already. I think the holiday the actual new year was earlier this week, but anyway, it's a week-long holiday in the world's second largest economy and maybe the world's second largest country in terms of population. I think India surpassed China, no? Or maybe they have the same population. Anyway, Indian growth has surpassed Chinese growth. Population of China 1.357 billion, and of India. No, sorry. China is still the world's largest country in terms of population. India is 1.252 billion, at least in 2013, at least according to Google. Anyway, hot pairs today and why? Well, I think the focus returns to the, well, first of all, to the US dollar. Hot pairs, hot and dangerous pairs, first of all, I would say the Japanese yen. Okay, because we have all this talk about intervention. Even if they do not intervene, any move to the upside will be seen as intervention. Okay. So this is a hot but dangerous pair. So I would say it's interesting. We have these releases in the US and the speech by Dudley, so the focus is on the US, which pair to trade against the US dollar. Perhaps the euro, just because it's sort of the default. And we have also GDP figures. I think dollar yen will be the most interesting pair to watch. Dollar CAD, perhaps because of oil, but euro dollar is also interesting. We're getting close to the ECB decision. We have talk about German banks. So perhaps dollar yen will be the hottest pair, but a bit dangerous, and euro dollar will be hot and perhaps a bit less dangerous. Okay, we're 100 pips off the highs, still on very high ground, still a nice move to the upside after this very frustrating range trading. Euro dollar is no longer a frustrating pair, and I'm really happy for that. Okay. Any more questions? Anyway, I'm also intrigued by dollar CAD, how 140 caps the pair despite oil prices falling to such low levels. Do you think the dollar is being strengthened because markets don't like the weak dollar? You mean this morning? I think it's a correction. It's a better mood in markets. First of all, dollar weakened because the rate hike expectations are lower. Weak figures in the US, especially last week's ISM non-manufacturing PMI. Today we'll have also big events. Retail sales is certainly a top-tier release. So that's why we have a weak dollar. But the recent strengthening, the US dollar used to be a big safe haven. It isn't such a safe haven, but it's sort of in the middle between the euro and the yen. So if we have a ranking of currencies in times of trouble, it's first of all Japanese yen, then the euro, then the dollar, then I guess the pound, then commodity currencies. But what we've seen since that ISM non-manufacturing PMI last Wednesday, the date was February 3rd, was that the dollar got a significant blow. We might be seeing some kind of a correction also this morning, but I see it more as a correction in the sentiment, which has improved just a bit. Okay. The chair of the Federal Reserve, Janet Yellen, she mentioned the strong dollar as a headwind to the United States, but inside a long list of risks. They have been mentioning the dollar since September, I think, so it's not something new. Of course, they would also like to see a slightly weaker dollar and slightly higher oil prices. So low oil prices support the US consumer on one hand. On the other hand, it hurts the US shale industry. So they would prefer to see some kind of, not high oil prices, of course, but some kind of more stable. Also for Europe, it's even more acute because not all the falling oil prices reaching consumers, high taxation here in the old continent, and but oil prices impact other prices of goods, and these impact the general inflation situation. Okay. Okay, let's begin the wrap up for today and then do the preview for next week. This is the wrap-up for the live market open for Friday, February 12th. Thank God it's Friday. Thank goodness. Finally, perhaps some kind of relief to markets after a wild week. What's going on? Currency wars have intensified to some kind of intervention. The Bank of Japan seemed to have intervened yesterday. Big spike of nearly 200 pips in dollar yen. Talks about emergency meetings. A sense of urgency in Tokyo and the government and the central bank. Also, the Swiss franc did some interesting weakening. Worries in global markets are about falling oil prices, reflect low demand, but also supply. Let's not overreact. Worries about German banks exposed to commodities. Worries about various companies. Yellen, in her second part of the testimony, the chair of the Federal Reserve, the most powerful central banker in the world, said it's not our fault. I mean, that in other words, of course, but said the rate hike was justified, okay? Of course, and she blamed a bit China, which is unjustified. There are so many factors. Anyway, the global markets are in a bear market. Remember, equity markets not always reflect the real economy. But a 20% drop from the highs in the world in general. Oil prices are a bit off the lows, but still on low ground. Okay, let's look at a bit at currencies in the wrap up. We have this morning we have some kind of an improvement in mood after the Nikkei crashed by nearly 5% after the sell-off yesterday. We have some kind of relief in European stocks. I don't think this will last too long. This relief means a stronger dollar against the euro and against the yen, so less demand for safe haven. Range for euro dollar currently 112.50 or 112.15 perhaps to 113.75. Further resistance 114.60. Pound dollar hugging 145. Perhaps some support there at 144.50 and then 143.65, stronger support, 146.50 on the top side. Dollar yen currently in some kind of range between 111 to 113 almost. Remember, the Bank of Japan may intervene. Canadian dollar showing some strength despite the crash in oil prices. 140 seems a tough nut to crack. 137.87 is support, 140 resistance. Aussie dollar, Stevens didn't say too much overnight. 70 is support, 71.40 is resistance, 72.20 further on the upside, 68.30 on the downside. Kiwi also in range, 65.80 to 67 resistance, followed by 67.40, almost at 66.66 as we speak. Today, the big events come from the United States. Well, we still have before that Italian GDP at 9 GMT, and then Eurozone GDP. Germany came out more or less as expected quarter over quarter, but a disappointment year over year. Let's see if Eurozone GDP meets the expectations of 0.3 quarter over quarter. I don't think we'll have huge surprises over there after Germany did not surprise on the quarterly figures. Then the focus shifts to the United States of America. Retail sales for January. Watch out for the control group, sort of the core of the core. Watch out also for revisions. Retail sales have disappointed too many times in 2015. This is the first report for 2016. Also, at the same time, we have import prices. At 3 GMT, we have consumer sentiment from the United States. Also important because it's a fresh figure for February. We're expecting a small rise over there. And Bill Dudley, number 3 at the Fed. Janet Yellen is number 1. Of course, Stanley Fischer, the vice chair, is number 2. And Bill Dudley, the president of the New York Fed, is number 3. He leans a bit to the dovish side, but is close to Yellen. So his words may be of high importance. Okay, before we do the preview for next week, I see a few questions here. Comments. Thought I read like 7 shale companies filed for bankruptcy. I didn't hear that, but if you know about that, I would like to hear about that. We did hear that Chesapeake, which is not involved too much in shale, there were rumors about this company, this energy company, that they have consulted a bankruptcy consultancy. They denied it. So far, so good. The denial worked. But if you have news about these 7 shale companies, I'd be glad to read about that. They're coming here. People like my parents will always be the stronghold of Deutsche Bank. They don't want to see nor hear evil, just keep saying we will never come to the worst, since it had come to worst before. So they leave their money with the banks and will accept everything. Well, I think people like your parents perhaps can trust the German government to back the savings of the money in Deutsche Bank. So if it's a regular account, I mean, we've seen so many governments bail out banks, so maybe there is reason to be confident. But in terms of the performance of the shares, that's already a different story. Anyway, let's do the preview for next week. This is the preview for the week beginning on February 15th up to February 19th, the third week of February. Let's see what's awaiting us. First of all, something that doesn't appear here, China is coming back online. They've been always online, of course. I mean, in terms of they had a long week holiday for the New Year celebration. Happy New Year. Anyway, China couldn't be blamed for the recent market rout, even, of course, that they were blamed. But anyway, on Monday, we have Chinese trade balance. The bottom line figure is not important. What's important is the direction of imports and exports. If these rise, it's positive. If they fall, it's negative. More economic activity is, of course, positive, not only for China, but for the whole world. China is the second largest economy. From the third largest economy, from Japan, we have GDP figures also on Monday. It's actually early on, Sunday for those in the United States. Also very interesting to see. This could impact the next decisions by the Bank of Japan. If we have a disappointing figure, it lifts the chances of some kind of intervention. Okay. Tuesday, we have focus from Asia. The focus moves back to the old continent. Inflation figures in the United Kingdom perhaps will be weaker because of oil prices and will trigger expectations for loosening or at least no tightening by the Bank of England. And the German economic sentiment is also released. It's expected to worsen. On Wednesday, we have the UK jobs report. Wages are, of course, important also in the UK. So we have back-to-back UK figures. And in the United States, we have housing, we have building permits, as well as PPI. PPI, Producer Price Index, is a warm-up for CPI. And housing has been mixed, but generally okay. Let's see if this trend continues. Remember, despite the doom and gloom in markets, not everything is really terrible. And at least a few sectors of the US economy are doing okay. On Thursday, we have the Australian jobs report. So far, so good also there. They were excellent, showed some kind of rebalancing to the local economy, not only China. Of course, currency moves a lot by China. And oil inventories, this time it's on Thursday. Oh, something I forgot to mention. China is coming back on Monday, of course, but there is a bank holiday in the United States. It's President's Day on Monday. It's a minor holiday, not a significant one, but maybe it'll impact volume. Of course, it'll impact volume in the US session. Okay, and on Friday, we have retail sales in the UK and inflation figures in the United States. Remember, the Fed talked about weak inflation, and they were okay with employment. So let's see how inflation began 2016. Of course, headline inflation expected to be weak because of oil, but core inflation has been relatively positive. Let's see if this continues. Anyway, with China coming back online, a lot of focus is on China, but we have lots of other figures. I expect another turbulent week in markets. Can't tell you where we're going because I don't know, but I have a high degree of confidence that we'll have a lot of action. Okay. Any more questions before we go? Let's take another look at markets. Well, an extension of the fall in euro-dollar, a better mood in markets, weaker euro-dollar, stronger dollar-yen, right? Yeah, not very strong, but at least off the lows. I think we'll have a very busy day today. Remember, it's also Friday. Every week it's Friday, but I'm saying it that because we have all these last-minute movements, closing positions. Of course, these are bigger at the end of the month, at the end of the quarter, and the year. But with all the turbulence in markets, we might see especially high, very strong action, especially coming after the consumer sentiment report in the United States. That could be quite exciting as well. Okay. Anyway, I want to thank you again for coming to the show. Wish everybody a safe and successful trading day. And also want to thank FX Street and you guys for voting for me. Forex Crunch won the best buy-side analysis contributor in the Forex Best Awards for 2016. Was thanks to the professional jury and thanks to you guys as well in the popular vote. And I'm of course very, very thankful for that. It was published earlier this week on FX Street, and also I of course published it. Took pride in that. So I want to thank you all once again. Thank you for coming to the show. If you know someone who is interested in trading Forex and doesn't know about the show, tell them to come along. Or if they're trading in a different time zone, of course, tell them about Dale Pinkert's excellent live analysis room. And I guess that's it. So thank you very much, everybody. Watch out for interventions by the Japanese and by other banks. And see you on Monday. That's it. Thank you very much, and have a great weekend. Bye-bye.